Hey everyone, welcome back to Yours Box. In this video, I'm going to look at TLT, the long bond ETF. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So I just finished making the video on the S&P, and I thought, why not make a video on TLT? Why not? Why not indeed? It's the small things in life that you have to enjoy. So, as far as recent history is concerned, I spoke quite clearly about TLT and how really I had one big concern, which was a retest of the previous trend line we broke out of. Now, this still is at play, and although we have held support at the bull market support band, that kind of mitigates the risk. And I think that next week is a very big week for bonds, and it can really help to determine where we're headed with bonds. So on Monday we have the S&P PMI reports coming out, and as I said for the equity side, it is also important for the bond side of the equation, because again, the question that you really have to answer, and that we're all trying to answer, is what we saw in February a one-off, or is it something, or is it a trend really? Is because what we saw in February is in reality something that is way more consistent with what we started seeing last summer than what we saw from September to January. And I think that there is a very important question that needs to be answered, because as I've pointed out many, many times in my videos, if you look at what happens, like just looking at what happened last year, okay, with inflation, starting from late fall, you had inflation, get bogged down at around the 3% mark, and really kind of drift higher until March of 2024. Now, why does it usually happen from the fall to the end of winter? Well, right smack in the middle, you have the holiday season. It's a time where people travel more, where people spend more, when people, generally feeling more upbeat about things, because it's the holidays. Who doesn't feel at least somewhat better during the holidays? And again, you get your end of year bonuses. So again, you have, by structurally, some factors that are playing into a more positive outlook this year, on top of having, again, the usual holiday optimism going on. You also had some momentary events take place, like we started in September with port strikes being threatened, and so that helped to pull forward some demand, because again, if you know that the port strikes, well, what are you going to do? Well, you're going to make sure you have everything stocked up for the holiday season. You don't want to miss that, any possible sales. After that, we had natural disasters in October with hurricanes. Then you had the election and subsequent tariff saber rattling and front running of the tariffs, and you had more natural disasters in January. Okay, so again, on top of what usually happens, you had a lot of significant events take place that helped make inflation look potentially worse. Now we're kind of where we were last year, okay? And the question we really have to ask ourselves is, what we saw from September up until now, really, is that what the economy really looks like, or was that just the result of events taking place and just something that was just passing by, okay? And again, as far as the last PMI report, this definitely poured cold water on, optimism in general. I think this line here in particular, optimism about the coming year slumped to its lowest since December 2022. And again, deterioration was a reflection of uncertainty about the business environment. And as I've pointed out many, many times, you have three things that you have to keep an eye on: tariff saber rattling, fiscal tightening in the form of consolidation at the federal level, so people potentially getting laid off, or even people seeing that people are getting laid off at the federal level, so they're acting in a more defensive manner. And again, the real beef when it comes down to federal layoffs is that yes, you have those people getting laid off, but all of the people that work around them are getting impacted. So think restaurants, services, everything that is that is dependent on those federal workers. Okay, those federal workers are income for a lot of different activities that by themselves have really no correlation to government workers, except the fact that that income goes to all potential different kinds of services. So if you have uncertainty caused by potential layoffs, that'll be a headwind to growth for certain. And finally, the yen carry trade, I made videos about that, and if you feel like it, you can go watch it. But again, coming back to TLT, next week is a fairly important week. I think that the first really confirmation of where we are will come with the PMI report. Currently, estimates are for a slight decline in manufacturing and basically services to be flat, to come in flat. Again, whether we continue to hold support at the bull market support band here is really dependent on the economic outlook. That's why I keep downplaying the squigglies on the chart, because at the end of the day, that's all they are. They're squigglies. If you have the S&Ps coming out, with upbeat news and an upbeat outlook, well, then again, the possible retest of the trend line is still in play, potentially. If you have weaker economic outlook coming out of the PMI reports, well, then it's more likely that what we saw here was actually kind of like, if you want to call it a bull flag, and it's just holding support of the bull market support band, then it's just primed for another run up. Again, we're really at a point, and as I've stressed many times, where we're really being held support. See, even I'm getting mixed up. We're really being held hostage by the economic data. If it comes in positive, then that's going to be positive for equities, definitely, and negative for bonds. If it comes in weaker, like we saw in February, well, it's going to be negative for equities and positive for bonds, because again, you're going to have lower growth expectations, and so that'll be reflected in the longer end and the longer end of the curve. Okay, so next week we also have PCE, which is another big number. You should definitely keep an eye out for that. Where is that? Right here. And again, the reason why I want to look at PCE is because we kind of had some drama, and I think that some of what the consolidation that we've seen ever since the beginning of the month is due to the fact that we got CPI, which was cooler than expected. We got PPI, which was cooler than expected, but the components that make up PPI also feed into PCE, which again was somewhat hotter than expected. So people are extrapolating that we might see a somewhat hotter print on PCE. Just keep an eye on, see how that comes out. Personally, my eyes are more on the growth side of things. Okay, because if you have again a significant slowdown, let's say that we get to the summer and things have slowed down significantly, lower growth is a killer for inflation. And again, I've made my views known in many of my videos. The reason why I'm not so afraid of tariffs is that And again, I could easily be wrong, but my favorite kind of survey of how people are feeling is the quits rate. I tend to dismiss the University of Michigan for the simple reason that it's filled with noise, and the noise is political bias. You're asking for people's opinions in those surveys, and people will give you their opinions, which are skewed by, if you're a Democrat right now, you think inflation is going, to Weimar Germany levels, and you probably think the economy is about to tank. And if you're a Republican, you think, it's the merry old land of Oz. With the quits rate, you have none of the noise. It's just what people are doing. What are people doing? And whenever the quits rate is at cycle highs, you know that people are leaving their jobs because they see abundance in the economy. They have many jobs they can choose from. And so the fact that they have many jobs to choose from is basically leverage. They can go to their employer and say, give me a raise, or I'm switching jobs, where I'll get more money. If, on the other hand, you're at the range lows, the opposite is true. People aren't seeing abundance, and they're getting a bit more worried about the state of things. And given the fact that people are more worried, as expressed by the low quits rate number, my suspicion is that any price increase from here on out is likely to have a deflationary effect, as ridiculous as that sounds, because the only way tariffs can be a problem, tariffs can be inflationary really, is if people have the tools needed to continuously bid up the goods that they want. Okay, and where do they have that tool? When the quits rate is going up, when they can easily get wage growth. If you don't have wage growth, and you see that people are acting in a more defensive manner, the probabilities that people actually say, you know what, I'm not going to buy that altogether because I can't take it anymore. It rises exponentially from here on out. And I suspect that is where we are. We're at a point where inflation is most likely going to impact businesses more, as they can't pass on that extra cost to customers. And if businesses have to eat it, that will manifest in the form of layoffs sooner or later. Because businesses really only have layoffs to as a weapon to react to shrinking margins. And again, this is just my take on it. We could very easily be still in a healthy position, but again, that'll just you'll have to wait for the data to confirm it or not. Coming back to TLT, PMIs, PCE. I don't think I'm missing anything else really. We have a GDP read, durable goods orders expected to come in weaker for the month of February. That's something that really bugs me a lot. We're practically in April and we're still getting February's data. In any case, really, I think the highlight for next week is the PMI report, because that'll really paint the picture of where we are. Are we somewhere that is, again, consistent with last summer, or are we still in fairly good shape, and was February just a one-off? I think a lot of answers will be a lot of questions will be answered next week in the PMI report. So I think that if you had to choose one thing to pay attention to, I'd look at the PMI report. Okay, and again, looking back at the PMI at the TLT, if the PMIs come in negative and confirm this kind of weakened outlook on the economy, TLT has more room to run in the short term. Also, keep an eye out for initial jobless claims. We don't have a forecast. Let me see if it's still fairly early. It's still Friday. In any case, it says 225. Again, my general expectation for, as I said in even my previous video, that we're likely to see initial jobless claims slowly drift higher as we move towards the summer. Any uncertainty, any negative outlook on the economy will act as a tailwind for initial jobless claims. So again, keep an eye on on this as well. Again, next week PMIs are king. If they confirm what we saw in February, then by all means call this a bull flag. And if they come out positive, by all means call this a topping phase and potentially looking to retest this trend line. And I'll close off just, something else I've mentioned in my previous videos. The question before we even start thinking about new highs on TLT and so lower yields is the low in? Again, that is kind of still something that bugs me. Now, I keep on trying to find things that, to poke holes in my in my own in my thesis here, because honestly, as I've pointed out, TLT usually likes to put in double bottoms. So the two examples I point out many times in my videos is that like in 2006, 2007, we saw a slightly lower low. In 2010, we saw a slightly higher low. So far, we are in the 2010 scenario where you have a slightly higher high, a higher low. And again, I'm just looking for confirmation that we're not going to revisit this this previous low. And I think that starts with the PMIs. Okay. It's not a matter of just one data point. It's a matter of having patience and waiting for more data to come out, because you want to see a trend, and a 1 month's data doesn't make a trend. It's boring, and it's you need to be patient. But again, the fun thing about trading, and however you want to call it, is that money has a way of finding its way to going from impatient to patient people. So log off. Don't look at the charts, because either way we're still being held hostage by the data, in my opinion. So just wait for the data to come out and to continue to add pieces of the puzzle. So to see again, are we in last summer, or are we still in September to January? Okay, I think that is a good place to leave it. Look at the PMIs, initial jobless claims, and PCE. Again, I'll leave it at that. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.